welcome to another edition of Investors Guide, a show where we guide you and help you on how you can make your money work for you. Over the last few episodes, we've been talking about the various categories of debt funds and how they actually fit into your investment portfolio. On today's show, we are going to focus on FMPs or fixed maturity plans, understand how they work and whether or not it is right for you. And to do that, joining me is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you so much for joining us on Investors Guide. Let's turn our attention to fixed maturity plans, FMPs. It's a very interesting category and it perhaps doesn't work for everyone. But nonetheless, let's understand how it works. If we could start there explaining to us how this category really works.
Yes, Avni, FMP is an important category like you highlighted because almost about 1,18,000 crores of assets are under 588 FMPs. So that's a reasonably large category in itself. In case of an FMP, as the name suggests, fixed maturity plan is what FMP is an abbreviation to. When you look at a fixed maturity plan, the fund manager's job is to collect money from various people in a specified period of time, 15 to 20 days. They collect the money. Once the money is collected, it is invested in different bonds of the similar maturity. And no one else, none of the investors can actually put in fresh money or take out the money invested. So it's a locked-in kind of a product. For 1 year, 3 year, 5 year, there could be different periods of an FMP. To summarize, FMP, a fixed maturity plan, is one in which investors accumulate the money together and the fund manager invests in bonds which are of similar period, equal to the period of the FMP, and the money accrues an interest and then gets paid out at the end. All the money gets paid out at the end, including the interest and the capital.
Right. So Feroze, the investments into fixed maturity plans is again something that should be highlighted, because it's not as if at any point in time you can go and invest in FMPs. You have to invest through a new fund offering, and then you're locked in for a certain amount of time, the tenure of that particular plan. That is something that also should be highlighted from an investor perspective.
Yes, Avni, like you said, it's very, very critical to understand that fixed maturity plans are not the most liquid options, because you put your money and that stays invested till the end of it, and you can't withdraw the money unless you can sell it on the exchange to a third party. So these are listed, but the liquidity is very, very low. So practically they are locked in, like you highlighted.
And they also carry a certain amount of risk. We're talking specifically about the interest rate risk as well as credit risk. Now, both these kind of risks are there for FMPs. If you can just highlight for our viewers and investors who are looking at this category, what one needs to be aware about.
I think when it comes to FMP, Avni, the more important risk and the prominent risk is the credit risk. And the liquidity risk, the second risk. Interest rate risk is reasonably mitigated because the bonds are held to maturity. If the fund manager bought 3-year bonds for a 3-year FMP, the interest rate movement wouldn't impact the maturity value, because the bonds are not being traded and they bought and held till maturity. So interest rate risk is the least risk. But the other two risks, like you said, the credit risk is the prominent risk, because when the fund manager lends the money to the companies and if the corporates in the period become defaulters and they don't pay back the interest, you can't do much because you have locked in your money. So credit risk is the most prominent risk because they are illiquid in nature. Credit risk, the fund manager is expected to manage by doing his or her analysis and investing in bonds of those companies who are powerful enough, who have a good business to repay the money in full along with the interest they commit for each of these bonds. So credit risk is the important risk. Illiquidity, because like in the month of March and April this year, quite a few people redeemed their money from other debt funds, but the FMP investors were stuck and couldn't take a U-turn on the decision which they had taken. I think these are the two more important risks. Interest rate risk gets mitigated because the bonds are held to maturity and not being traded by the fund manager on a recurring basis.
Right. Feroze, let's talk a little bit about who should be opting for this category of funds. How does it make sense into fitting into one's investment portfolio? Because obviously it allows you to lock in an interest rate at a certain rate, despite however the rates may move going forward, and that can give you that edge in terms of returns. But in the falling interest rate environment that we are in right now, what is the advice on this category?
You're right, Avni. The most biggest or the prominent advantage is to lock in an interest rate. Whenever the interest rates are higher, an FMP's relevance becomes that much more, because if, for example, a year back, if interest rates on AAA rated 3-year bonds was upwards of 8%, people locked in the 8%. Today, if those bonds have an interest of 6%, the FMP investor who was prudent enough to lock in the interest at 8 is enjoying 2% more than most other investors. So in a falling interest rate situation, the FMP's relevance just goes up. But I think currently as we sit, most of the rates across the yield curve, across different periods, 1 year, 3 year, have come down dramatically. So today an FMP's relevance is lower relative to what it was a year back. But there would be time in the future where interest rates will sharp risely. If they do, then FMPs could be a very important product from your portfolio standpoint. That's one. Second, anybody who has a predetermined goal, for example, if you wish to buy a car 3 years from now, and the debt component could be used with a FMP.
Okay. And what about the tax aspect, Feroze? Because if you were to compare this to a fixed deposit, for example, this would work out more tax efficient, especially if you are in there for the 3-year tenure.
Avni, FMPs which are less than 3 years are tax inefficient. They could be as tax inefficient or efficient as much as an FD, depending on the person's tax bracket. Their tax treatments would be identical. If you are buying an FMP upwards of 3 years, you will get the indexation benefit along with the 20% capital gain bracket, which is 20 plus cess, which could reach up to 22-23%. So point I'm making is 3-year plus FMPs are tax efficient. The lesser than 3 years are tax inefficient. And if you actually get the indexation benefit, the average tax comes down to 9-10%, not 30%, which an FD can have for the highest tax bracket.
Right. And like you pointed out, we've been seeing huge outflows in this category since March this year. There's been a 20% decline in the number of active FMPs. But for the time being, I mean, later on we could see a time when FMPs come back, as a flavor of the month. But for now, is it something that you would recommend, or you would suggest that investors look at some sort of alternatives to this category?
I think people should look at alternatives to this category, because the current interest rates of a 3-year FMP range between 5.25% to 6%, depending on the quality of bonds being held. And I personally think that this is not the best time to buy FMPs. Because if you're anyway committing the money for 3 years, that's when you get the tax efficiency. You're better off looking at an asset allocation between equity and debt, and definitely there is a higher probability, not a certainty, to make far more than that than locking in your money at 5.5% pre-tax.
All right, Feroze, we'll leave it there. But that's as far as fixed maturity plans are concerned. This is a category of debt funds that, like Feroze pointed out, may not be the best idea in the current environment, but there could be a time going forward where it perhaps could be a good fit for your portfolio. On that note, it's time to wrap up this edition of Investors Guide. Thank you so much for tuning in.